Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee. With me is Abha Bakaya, and our guest on the show today is Prashant Khemka, founder of White Oak Capital, joining us from Singapore today. Prashant, great to speak to you again, and Diwali greetings first from all of us. It's been a remarkably resilient market. Let me ask you if you're surprised with this kind of resilience, and more importantly, do you see it lasting?
Certainly, Diwali wishes to you and Abba as well, and thanks for having me on the show. So, Dan, if I can segment my comments into three aspects: the economy, the corporate, and the market, and look at these from the global as well as the Indian perspective. So, what's troubling? The global economy first. So 2 years or 2.5 years now ago, there was this, when COVID hit, the big worry was that we would have demand collapse, which would result in a supply glut. And that's why you had prices crashing and worries about deflation. That's why you had negative oil prices in the spot and so on and so forth. Very soon, the reality turned out to be barely any demand destruction, but in fact, there was supply disruption, and hence inflation picked up. So the biggest worry or problem or issue the global economy has been grappling since then is inflation. Initially, it was expected to be transient because it was COVID-led supply disruption. So as COVID would pass through, the supply chains would fall back in place. Now, that COVID disruption hasn't quite resolved itself because China, which is a major link in everybody's supply chain globally, is still enforcing a COVID zero policy, which is leading into feeding into the supply disruption. And while this was continuing, there was a much larger shock to and a much major supply disruption that was due to Russia-Ukraine war. In many commodities, supply got cut down, or again, the disruptions caused long delays. So as a result, spanning over these 2 years now, inflation expectations have become more entrenched and can no longer be viewed as transient. And hence you see globally interest rates climbing, the longer term interest rates climbing, as well as the near term, the Federal Reserve Bank, as well as other central bankers boosting near term interest rates to contain these inflation expectations from getting entrenched. Now, this is the global situation. In India, it's not being felt as badly because Indian inflation basket is quite a bit different from the US or European basket or global basket in general. So at times when we have high inflation, these other countries and other regions don't have any inflation. And this is a time when we are having higher than normal inflation, but not something that is outside of the range that we have been used to. In Europe and US is the first time after 40, 50 years that they've seen inflation climb up as rapidly. Otherwise, inflation since the early 80s has been on a one-way downward slope globally. Whereas in India, we had double-digit CPI inflation, you'll remember, not long ago. I mean, 2008, 2009, due to various reasons, we had even in the teens, the CPI inflation. So right now, inflation in India is 7 to 8%, call it high single digits, which is within the range of what we are used to. The last 20-year average inflation itself being 5 to 6%. So 7-8% in context of 5-6% isn't hurting as much as it is hurting the developed world with 7 to 8% compared to 1%. So that's one point as it relates to economy, with inflation being the biggest issue globally, not as much in India. When you look at corporate sector, obviously the economy, besides inflation and as a consequence of inflation, there's slowdown in the US, and as a consequence of inflation plus the war, there's major slowdown expected in Europe, which is then hurting corporate sector in these countries as demand slowdown, as they are stating a demand slowdown. Whereas India, to some extent, while in India, you see there are conflicting forces, while there is some slowdown because of global slowdown impact. At the same time, India is benefiting from the China plus one and now Europe plus one strategy that many corporates are pursuing in their sourcing and supply chain arrangements. And at the same time, if you look at sector by sector, the banking sector has never been in as good a shape as it is today, and it's a large sector of the economy. And so, corporate India is not expected to have such a slowdown in earnings as the slowdown in earnings growth in the developed world and even in China and other EM countries. And as a consequence, the market has held up better in India, has been more resilient in India because there isn't the expectation of decline in earnings or such a major sharp slowdown in earnings growth as it is elsewhere in the world. And there are other factors, not just earnings growth, other factors besides economy and corporate. If I may club them in the governance bucket, China has undergone a major change in its governance over the last few years, and it's been enshrined right with the third term. So it's moved from what was a one party system, which is at least partial one party democracy within the party, to more of a single person rule. And that's caused a substantial derating in China. And that's benefited Indian markets with increased flows compared to some of these other countries which are facing trouble.
Right. Now, Prashant, you've put in perspective what has happened over the last 1 year and where we are today. But what do you see for the year going forward? Because, while your point is taken, a lot of people believe that there will inevitably be some kind of economic slowdown post the festive boom exhausts itself. And that will lead to some kind of earnings slowdown as well. Not massive, but some kind of earnings slowdown. Do you think India will be able to sustain its 20 kind of P multiple, these kind of elevated valuations, in the face of a global slowdown and some earnings slowdown which might happen in India?
So yes, Udin, there is expected to be some impact on corporate earnings in India as well, because while we might not be impacted as much by these global developments as some other countries are, we are nonetheless not insulated. So there is bound to be some impact of this, and the earnings growth would be somewhat slower than in the absence of a global slowdown. But that's also the reason why, actually, if you see year to date, and we are already in at the end of October, the markets haven't gone anywhere. So they have corrected, if you will, by nearly a year. Indian markets are flat year to date. Relative to the world, so the multiple has somewhat come in for Indian market, and at this time it is around where the average multiple has been over the last 8 years, since 2014, under this government. Relative to the rest of the world, multiple has expanded, particularly relative to the global emerging markets. The multiple has expanded substantially, or the relative difference has expanded substantially. And that's primarily because of the collapse in multiple of China, as I was describing earlier. And China was, as you know, 40%, nearly 40% of the emerging market basket. And so if 40% of the basket declines by around 50%, as it has done over the last couple of years or so, the multiple shrinkage has been very substantial over there, and that's impacted the overall EM multiple as well. And hence, Indian multiple is at a much higher premium today than it has been over the last couple of decades relative to EM.
Sure. Prashant, markets have made quite a, valiant comeback in the last few weeks. But given the backdrop that you've just described, how would you advise really maneuvering the market right now? Would you stick to some of the safer plays? Would you go with, some of the stocks that have a very bullish view with regards to domestic economy and the kind of growth they could see on the back of that? Financials have been a big talking point of late. Is that a story that you're looking at? What would be your approach?
Certainly, Abha. So just to be clear, our team and our approach at White Oak is very bottom-up stock selection driven. We don't try to time where we are in the cycle and how that might impact the different sectors. We rather focus on identifying and investing in what we believe are the best companies at the most attractive valuations in each sector. and that can outperform over the cycle their respective sectors. And if we are able to do that across all sectors, then it doesn't matter where the market is headed, is our belief. But having said that, where we are finding the most attractive opportunities today, Abha, are it's also in line with what historically has been the case, is in private sector financials, because there are some extraordinarily well run private sector financials in India. There, I would say, not just within Indian context, but having invested in financials or banking sector around the world, I would say some of the Indian financial sector companies in the private sector space are the best compared to anywhere in
Yeah.
are available at fairly reasonable and I would say attractive multiples compared to their own past, but also now compared to at what valuations they are compared to some of the emerging market peers. So that's one area where the team continues to find a lot of opportunities to invest. Another area is the whole consumption related, not only staples, but consumer discretionary segment as well. We've always found some very good opportunities. Yes, if there is a slowdown and if there's a sharper slowdown, then it would hurt the discretionary demand as well. But again, we can't take a top down view on the economy and then bet the whole portfolio or tilt the portfolio to align with that. In my experience over the years, that just induces a lot of volatility in performance without adding any alpha or without adding any performance. So we have a balanced portfolio, which we expect to do well, regardless of where the economy or the market is headed in the near term. And in the long term, the stock selection should shine through. So consumption related, particularly discretionary consumption related, we continue to find a lot of very attractive opportunities. And then the third segment I would highlight is, which has been under pressure of late, is what we call value-added exports, where India has a strong positioning. And so when I say value-added exports, it's not necessarily to do with bulk commodities, which India anyways has fairly less of. But for example, IT services is entirely value-added export.
Okay.
Also specialty chemicals or pharmaceuticals, these are all examples of value-added exports, and we continue to find attractive opportunities in both IT services and specialty chemicals in particular. So these are the.
Let me take the last bit, Prashant, because that is a contentious one. The street is quite divided on what to do with IT services now, because these stocks have underperformed, and there is a growing belief that it will not outperform in the near term. What gives you the conviction that IT is the space to be in, despite the global headwinds?
Certainly, Udayan, very valid point. See, despite the near-term headwinds, it is a very large segment of the Indian market with a large number of companies where you can distinguish between who can be potentially strong performers going forward over the next 5-10 years, over the next cycle, if you will, versus those who might not be able to keep pace with the sector. And also, this sector is down 25% year to date or thereabouts. So it's not that the market doesn't already know or hasn't already reflected a lot of the impending pain. It is quite possible, if you listen, I'm sure you have, listen to all the commentary from these companies. Yes, there are some signs of slowdown in or some tentativeness in the demand environment, but they continue to report fairly solid numbers. And yes, we acknowledge and we believe as well that next year and the year after might be slower than the current year and the prior year. But just as it has always been impossible to, if we were to wait till the demand environment or outlook becomes more positive or more benign, the stocks would have already rallied 40-50% or something like that before that becomes more widely acknowledged that the demand environment is like COVID is a good example. In March 23, a lot of these sectors, including IT services, were badly beaten up because the demand environment for these was supposed to get dried up. And at that time, pharmaceutical was everyone's consensus favorite sector because everyone would be just taking pills and vitamins and vaccines was the thinking. And since then, while from a real economy perspective, it all made sense. But since then, pharma has been the worst performing sector as it got priced in very immediately. And IT services actually ended up doing very, very well. And so, to go back to what I was saying a few minutes earlier, we need to keep a balance in the portfolio. We cannot tilt the portfolio entirely in a position that assumes that the global economy would continue to do poorly and get worse than what is expected, because a lot of bad is already expected. The real question is whether the reality would be worse than what is the bad that is expected to be, or in line or better, which nobody really knows.
You mentioned some sectors like financials and consumer discretionary, but I didn't hear you talk about any industrials, because there is a feeling that the capex theme will come back sooner or later, and some of the industrials have actually begun to price it in as well in the market. Where do you stand on that?
We do own, Udayan, a few of the industrial names as well, particularly in the small and mid cap segment. I just didn't highlight it because it's not a very large portion of the portfolio, like financials and consumption and the value added exports. If I were to say all, which is IT services and chemicals put together, this would at least be mid-teens to 20% or even 30% each segment of the portfolio. But industrials would be more like mid to high single digits, and hence I did not highlight Udayan, but there are a few mid to small cap names that the team has invested in industrials. And it is expected to, the sector earnings growth for this sector is anticipated to be very strong over the coming years, because they've been in a lull in pits actually for a long time, since 2008-9 time frame, 8-9-10 time frame. There has been a lull in capex. And this is the first time after a long time that capex is picking up, part helped by the China plus one and the Europe plus one that I mentioned earlier, but just domestic capex of in various industries is picking up. So the industrials are expected to show one of the highest year-over-year earnings growth.
Absolutely. Prashant, just interested to hear your take on defense. I know there are select plays in the sector, but given that we're seeing a huge push by the government on Make in India and the export push coming in there, the fact, of course, naturally, given the current scenario, there has been a refocus towards some of those defense names, and we've seen some pretty strong moves as well with the likes of NHAL, for example. What's your view on the theme?
No, absolutely. Defense is, as you know, very much part of the industrial bucket that Udayan was referring to, and possibly the fastest growing segment within a very fast growing bucket. Right? The problem with defense, though, is, as you know very well, there are very few choices to invest. Just historically, India has been largely dependent on imports. This government has made a big push towards boosting the domestic industry. Quite a few companies have gotten listed over the last couple of years, but there's a long way to go, and many more private companies should come to market over the coming years, is our view. Right now, this segment, is quite largely, there are first of all very few companies, and a disproportionately large share of those companies is in the government-owned space, which we tend to struggle to find good investable opportunities in. But having said that, they would all see very, very strong earnings growth over the coming few years.
Prashant, good hearing your thoughts as always. Thank you very much for taking time out for us today.
Thank you, Prashant.
My pleasure. Thank you, Udayan and Abha, for taking the time and having me on your show. Thank you.
Thank you.
If you like the video, do like, comment, share and subscribe.